The Federal Reserve's preferred inflation gauge edged higher in July, reversing some of the prior month's sharp drop as the central bank works to bring inflation back to its 2% target. Core PCE rose 4.2% over the prior year in July, in line with economists' expectations, while headline PCE inflation also met expectations, rising 3.3% year over year. Joining us now for more on what this all means for the markets and the Fed moving forward, we've got Johan Grahn, Allianz Investment Management, Head of ETF Strategy. Johan, it's good to talk to you today. What's your read on what the data today says about how sticky that last mile is going to be for the Fed and getting to 2%?
Well, it's been a bit sticky, but the key issue is really where we're going to go next and where the Fed is going to take rates. And they've been trying to push up now for quite some time, as you know. They've been hiking rates 11 times over the past 18 months. There will be a bit of a lag on the in terms of the effect on the economy itself. Everybody's fully aware of that, and it's just now starting to really work its way through. So the fact that we've seen declining inflation in spite of the growth in GDP that we've seen, and also the very tight labor market that we have, I think they're focusing on the fact that the trends are going in the right direction as it relates to inflation, because the full impact of the rate hikes we still have yet to witness.
You mentioned that tight labor market. We will get the August jobs report numbers tomorrow. The expectations are that those numbers will be in that sweet spot, but how sustainable is that as we head back into the back half of the year, and just considering where we're at in the current economy?
Well, there's no doubt that you have some pressure building up. There is always a lot of conversations now around earnings pressure, and you have companies looking, for ways to cut costs when it becomes more difficult to keep hiking prices. Effectively, the consumer has had enough in many cases in terms of price inflation. So, in case of in that particular case, you will continue to see this playing out. But the long story short here is really the fact that whether the numbers come in at the expectation, I believe it's at about 170,000 jobs, or if it's 150 or 200, will have very little impact in terms of the outcome and what the Fed is expected to do in September.
Johan, going back to what you said earlier, that the trends are going in the right direction when you consider the economic data, does that mean no more hike?
I believe so, yeah. No more hikes in September. I don't think we'll see any more hikes this year. This is the time where the Fed has earned its right after climbing high now for 18 months. They have earned the right to take a break and to institute what I would refer to as a wait and see period to see how things shake out. What they've been trying to do is hiking up this enormous mountain now for some time, and they need to figure out whether the data will support that they've actually reached the peak of this mountain, or if they're still sitting at a false summit and they need to do more. But for them to be able to make that decision, they need real confidence around the data that they see, and that will take some more time to build up, as Jerome Powell has hinted at as well.